Well, on the interview segment on the show today, managing inflationary pressures and dwindling foreign reserves is our focus on the show. Headline reports for the week show that Nigeria's foreign reserves dropped by $544.94 million from $36.17 billion as at July the 1st to hit $35.62 billion in the month of August the 13th. Now, that's the latest figure from the Central Bank of Nigeria. The CBN, during the last Monetary Policy Committee meeting, stated that the volatile nature of oil prices would continue to have implications for the country's macroeconomic aggregates. Meanwhile, the Consumer Price Index, which also measures inflation, increased by 12.82% year-on-year in July this year. This is about 0.26 percentage points higher than the rate recorded in June. That was pegged at 12.56%. Now, joining me via Skype to discuss the implication of these figures on the state of the economy and prospects of any possible recovery, I have the Chief Executive Officer of Cowrie Assets Management Limited, Johnson Chukwu. Good to have you on the show today.
Thank you, David, for having me.
Now, one of the biggest tasks Nigeria's had to face is managing inflationary pressures. Now, the COVID-19 has also highlighted and also heightened the risks that we are having at this point in time. Now, looking at the current figures, the National Bureau of Statistics is released. How do we manage through steering the course of inflation at this point in time? I remember our last conversation, you say we might likely see even hitting about 14%.
Yes, David, the reality is that the inflationary pressures are coming from sources that will be difficult for the government to manage in the immediate future. Take, for instance, if you look at the July inflation figure of 12.82%, you realize that the greatest pressure came from food inflation. Food inflation grew from 15.18% to 15.48%, whereas core inflation, which is all item inflation less the volatile food items, was actually decreased from about 10.13% to 10.1%, which simply means that the pressure is, like I said earlier, is coming from food items. And as it stands today, one of the pressures is coming from the fact that we closed the border since August last year. And since we closed the border, we've seen consistent increase in inflation because we are not yet able to produce enough quantity of those food items that we were importing as to offset the gap between demand and supply. And until that is achieved, you must continue to see pressures from the food side. We are not even seeing the expected increase from other items, which will come when the core inflation also begins to rise. And that will come from the gradual and consistent increase in price of fuel. So looking at the current macroeconomic environment, it is very likely that we'll continue to see inflationary pressure in this near future.
And do you still maintain the stance that we might likely hit the 14% peg, or this is going to go higher, looking at how we are steering through the third quarter and likely into the Ember month as well? We know prices of food always goes high within the Ember months. The demand is there, and no doubt, but the pricing is just the much talked about detail we have to fix.
Well, I think we see further increases. It may not get to 14% before December. Why do I say is that we're going to soon move into the harvest season. When you get to the harvest season, the rate of increase in food inflation will moderate. Not that we are going to see a deflation of food inflation, but we're going to see a reduction in the rate of increase. So that pressure may abate to some extent. But the pressures will come from other sources, like I did mention. We are seeing consistent and gradual increase in price of crude, and the Nigerian National Petroleum Corporation had vowed to liberalize or allow market forces to determine the price of petroleum products. So if they stick to that commitment, you will see consistent increase in the pump price of fuel, which has a direct cost implication on transportation. And we all know how pervasive the impact of transportation costs could have on other items.
Exactly.
It could also affect food inflation further and every other item in the consumer price index. So I think beyond food inflation, we should expect pressures to come from other sources. And that's why I said we should expect further northward movement. But I don't know, I can't say categorically that we hit 14%, but it won't be too far from approaching that threshold.
And talking about also still managing all of these pressures at this point in time, what, if you were to have an advice to the economic team at this point in time, what should be the measures we should take? Because leaving things at the way they're spiraling out of control, this has been consecutive month-on-month increase. It's quite alarming, and for so many analysts, they just feel that the worst scenario is that we might have a much more dilapidated issue in the country.
Well, David, the key thing for me, if I'm here to be in their position, is that I need to prioritize. I need to ask myself what should be of critical importance to the country today. Like I said, we should expect further pressures from that further northward movement in inflationary rates. But remember that we're dealing with an economic contraction, we're dealing with a possible recession, and we are dealing with an increase in level of unemployment. So those should be priority number one for the economic managers. And if they are priority number one for the economic managers, we should be ready. They should be ready to accept the cost of stimulating the economy, which could include an increase in inflation. The other pressures that I have not mentioned to you, we're seeing pressures on price level coming from changes in exchange rate. Of course, we know the Naira has come under pressure. We've seen an Naira depreciation in the past couple of months. We've seen even the central bank has adjusted its own rate from 360 to 380. And we know that the foreign market is doing about almost 480 today. So those pressures are going to translate into price levels. By the time they reflect on the cost of imported items, we should see further pressures on inflation. But like I said, if I'm to advise, I would say let's prioritize, and the priority should be how do we stimulate economic recovery? How do we create employment, even if they are going to come at the cost of a higher inflation? The reality is that when we stabilize the economy and we have higher level of productivity, inflation will begin to moderate. I did mention that the pressures on inflation today, the July inflation pressure came largely from food items. So expansion in food production, expansion in cultivation, it might take some time to achieve that traction, but that is the way to go. The other option you have is to ask the government to lift the restriction on the borders and allow for importation of some of that, but it amounts to reversal of an existing policy that has incentivized people to go into agriculture. So I wouldn't recommend that.
Now, let's play pundit a little bit. Now, looking at the role of the CBN and how much the decision of the MPC has on the economic stance of the country. Now, let's talk about any forecast from that view. Do you think there'll be a change in stance, retaining the current indices parameters that we have, or do you think there might be a likely shift based on the inflationary reports we are getting?
I doubt any shift. Like I said, if you look at the CBN governor's announcement on the last MPC meeting, he said that they recognize the inflationary pressure, but that tightening today will negate everything they have pursued. And Nigeria is not only one country that is actually adopting the expansionary monetary policies as well as the expansionary fiscal policies. At periods of economic downturn, at periods when the recession is staring you on the face, the most appropriate thing is to adopt expansionary fiscal and monetary policies, which is what the central bank has done, and the fiscal authorities are also doing by increasing the budget to about 10.8 trillion naira. This will clearly have put pressures on the consumer price index, which is what we're seeing. But unfortunately, we're also seeing pressures coming, not even from money supply. We're seeing pressures coming from food inflation, from demand for food items outstripping supply. So this other pressure will still come. The effect of liquidity overhang coming from fiscal disbursements, coming from monetary policy expansion strategies will still come to affect the inflationary rate. So for the monetary policy authorities, they will certainly want to adopt a policy that will rather push for economic recovery, even if it's going to come at the cost of inflation. And so in that wise, I don't expect them to deviate from current policies, which are let's stimulate the economy as much as we can without overly creating a liquidity suffix in the economy.
And now the month of August has had so many economic reports released. Now we have unemployment rates soaring. We have our reserves, foreign reserves also dropping quite fast. In 6 weeks, we've seen over $544 million lost. And also looking at inflationary pressures also heightening at this point in time. But with a focus on Nigeria's foreign reserves at this point in time, what do you make of the supposed free fall, the drop we've seen so far? And what do you make of it? And looking at how to manage this drop as well, expanding our revenue generation base, especially getting the forex.
Well, interestingly for us, to expand our revenue generation base is not going to be a light bulb effect. There's almost little we can do in the immediate to expand our revenue generation capacity. I mean, foreign currency revenue generation capacity. That would take some level of restructuring of the economy, some level of improvement of our value chains, some level of reduction of our cost of doing business and cost of production in the country, and improving infrastructure supply, including power supply, to reduce those costs. But in the meantime, the decline in foreign reserve was most expected by people like me. And why do I say so? There are three major sources of foreign exchange earnings that the country rely on. One is proceeds from sale of crude oil. As we know, the crude oil price had dropped drastically in the past couple of months. We are currently seeing a crude price at best about $45 per barrel. At the same time, we are seeing a drastic reduction in our crude production. The last report I had said the crude production is about 1.3 million barrels per day. But I know even if we have the capacity to produce to the OPEC limit that has been assigned to us, our OPEC limit is currently about 1.4 million barrels per day. Compare that to last year when we were producing about 2 million barrels per day, and crude price was in the neighborhood of $64 average per barrel. So clearly, from that major source, which is the greatest source, which accounted for more than 70% of our foreign exchange earnings, close to 80% of our foreign exchange earnings, we saw a decline. The second leg of our foreign exchange earning comes from foreign portfolio investments. We saw a sell down starting from the month of February, March by foreign portfolio investors when COVID-19 became endemic in Western countries. And we've seen a non-reversal of that trend. We've rather seen consistent efforts by foreign portfolio investors to exit the Nigerian market. Those who are still bidding are because their funds are trapped. And unfortunately, we are not able to meet the demands of those who are trying to exit. And until you allow those who want to exit to leave, then those who want to come in will not be willing to come in. So we really need to address that. So we have seen a drastic decline in inflows from foreign portfolio investments. Then the third leg is remittances, diaspora remittances. The major sources of those diaspora remittances are the UK, US, and other European countries. As it stands today, though all those countries are struggling to keep employment, people are living on handouts from the government. A lot of companies are not able to sustain payment of salary. So you see instances where the government has weighed in to support those companies. So it's not a time when those people who are living on handouts from government will be in positions to be remitting money home. So clearly, that source has also declined because of the economic effect of COVID-19. So you look at those three sources of inflow, and you can see three of them have come under pressure.
Exactly.
At the same time, we are seeing a vast flow. We are seeing portfolio investors who want to leave the economy. So it was most expected. If your inflows have declined and your outflows are increasing, you should expect a reduction in your reserve, which is what we saw. So it was most expected.
Okay. So now we're wrapping up conversation now in terms of accessing funds and exploring new opportunities, frontiers, as we also have emerging sectors of the economy coming into bear now. At this point in time, what's your word to government in terms of exploring the capital market much more aggressively? And at the end of the day, what's your outlook after doing a computation of all of the figures we are having, which clearly gives an impression of our economic standing? What sort of recovery do you think would have first the capital market and then the recovery pattern you see?
Okay, on the capital market, if I'm to advise the government, I would say the government should look a bit more inwards to access funding from the capital market. If you look at the capital market today, the bond segment of that market is more than $28 billion, 28 trillion naira. So that shows the capacity of the local economy to fund financial assets that have good returns. So the federal government should look more inwards as it stands today, particularly for infrastructure development. We cannot afford to continue to borrow externally at this point when our sources of foreign exchange earnings have declined. Otherwise, we're going to be put under pressure to meet repayment obligations, particularly foreign currency repayment obligations. For local currency obligations, it's easier for the government to deal with because the government is a sovereign, which means it can print currencies and can also tax the citizens. From those sources, it can always meet its local currency obligations. So I think the government should explore more the capacity of the capital market to fund infrastructure and moderate the possible implication of COVID-19 on the economy. As it relates to the recovery, the outlook, Nigeria's economic outlook, on economic recovery outlook, I would say that it will all depend on the policy options that the government chooses. If we get the policies right, if you look at the economic sustainability plan, the government had made provision that if it injects about 2.3 trillion naira into the economy will only contract by 0.59%. I think that may be a bit more optimistic than what the reality is indicating, because we have also seen global institutions putting recessions of more than 4% for the economy, 3.4% for the economy. But I think the choices are there. If you take the right choices, one of which, for instance, I said, for instance, the Monetary Policy Committee, the Monetary Authority should allow those foreign portfolio investors to exit. Those Bloomberg said we have about $2.5 billion of foreign portfolio investment trapped in the economy. We should allow them access forex to exit so that new people can come in. That way will restore flow from foreign portfolio investments.
Okay.
We need to harmonize the exchange rate. It's been a talk point for some time by both local and foreign investors. We need to take out the subsidy on petroleum products and free up resources for infrastructure and other critical sectors of the economy. Some of these policies might be daunting because of their political implications, but they are the right things to do. If we do them quickly, we most likely have a V-shaped economic recovery. But if we delay and then the pressures keep building, we might have an economic recovery that will be U-shaped. Okay. But like I said, it all depends on the policy options.
Okay. Thank you very much for your contribution on the show so far today. Johnson Chukwu, the Chief Executive Officer of Cowrie Assets Management Limited. We've explored both the best and worst scenarios, and we can only hope that government takes all of the necessary strategic actions to get the country back on a path of recovery. Thank you once again for your time.
My pleasure.
Well, on this note, this is where we wrap up this edition of Business Week. Many thanks for watching so far. My name is David.